Hey everyone, welcome back to the channel. If you're new here, I'm Aditya, and this is part 2 of our deep dive into the Indian stock market. In the first episode, we looked at how the Indian stock market evolved from a colonial trading floors and chalkboards to a structured financial system. But the real boom, that came after post 2000, a period defined by strong reforms, tech upgrades, and one major shift: the rise of the retail investor. Today, we're going deep into the transformation that shaped India's markets into what they are today: young, digital, and buzzing with potential. Let's get right into it. Number one, the liberalization was the spark, but reforms lit the fire. Let's rewind back to the early 2000s. India had just opened its economy a decade earlier, in 1991. A stock market had gained some structure with introduction of SEBI in 1992, which was created to regulate the market and protect investors. But despite these early wins, the market was still elitist, opaque, and a bit chaotic. A huge shift came with dematerialization. Earlier, if you wanted to buy shares, you'd get actual physical certificates. Imagine needing to store pieces of paper to prove you owned part of a company. And if you lost it, tough luck. That changed in the late 90s and the early 2000s with Demat accounts, which allowed shares to be stored and traded electronically. This was revolutionary. Suddenly, buying and selling became faster, more secure, and accessible. You didn't need a broker in a fancy office anymore, just a digital account. Around same time, electronic trading platforms started replacing the old school open outcry system. Instead of shouting orders in a crowded room, traders were executing with traders were executing trades with just a few clicks. It made the market more efficient, transparent, and most importantly, scalable. That that's not all. SEBI started tightening its grip, bringing in regulations to limit insider trading, protect small investors, and improve disclosure norms. This built trust, which is everything in finance. So, what you had by the mid 2000s was a market with a decent infrastructure, improving regulation, and a growing economy. But it still hadn't become massive yet. That's where the next 2 decades come in. Enter the millennials, the retail investor boom. For most of independent India's financial history, the stock market was seen as a risky, even shady business. People preferred FDs, gold, real estate, or at most LIC policies. Investing in the stock market, that was for brokers, speculators, or rich people. But starting in the 2010s, the image started changing, slowly, then all at once. The key driver was technology. Trading platforms like Zerodha, founded in 2010, changed the game by offering zero brokerage trading and a clean digital interface. Others like Grow, Upstocks, Angel One followed suit. Suddenly, investing was as easy as ordering food online. On top of that, India's digital backbone was evolving. The Aadhaar simplified KYC, UPI, and online banking made transactions seamless. And smartphones? They brought the stock market to every pocket. This led to a massive explosion in Demat accounts. Between 2016 and 2023, the number of Demat accounts in India went from under 2 crore to over 12 crore. That's six times growth in 7 years. Most of it driven by first time investors from tier 2 and tier 3 cities. But access alone doesn't create a retail revolution. Awareness matters too. And here's where YouTube, social media, and FinTalk changed the narrative. Channels like Pranjal Kamra, CA Rachna Ranade, and Ankur Wariku started simplifying finance. Meme pages started making sense jokes relatable. Investing became cool. And FOMO, that just sealed the deal. Everyone knew someone who made money in the 2020-21 bull run, especially after the pandemic crash. Retail investors, especially younger ones, started entering the market not just to save, but to build wealth and own a piece of India's growth story. Number three, why retail investors actually matter. Now, you might be wondering, okay, cool, lots of people join the market, but does it really matter? The short answer, yes. Retail investors are shaping how India's markets move. In fact, in recent years, domestic retail investors have often cushioned the impact of foreign institutional investors, FIIs, pulling out of the market. Earlier, FIIs like hedge funds or global asset managers could cause massive volatility. But now, local retail investors absorb some of that shock. They're not just some background noise anymore, they're part of the backbone. According to NSE data, retail participation in daily trading volume is at an all time high. In small cap and mid cap stocks, retail investors often dominate. Even mutual funds, which manage crores of public money, are being funded by SIPs, systematic investment plans, a retail invention. Over 15,000 crore flows into SIPs every month now. That's household money from teachers, engineers, students, freelancers, all fueling the market. So, yeah, retail investors aren't just following the trends anymore, they are setting them. Number four, IPOs and India's startup era. Let's talk about a trend that turned the Indian market on its head. IPO wave of the Indian startups. From 2020 onwards, we saw companies like Zomato, Nykaa, Paytm, Policybazaar, Delivery, and Mama Earth go public. This wasn't just a financial event, it was cultural. For the first time, regular investors could own a piece of the applications that they used every day on their mobile phones. That Zomato order you placed, you could now be a shareholder in that company. But these weren't traditional profit making giants like Infosys or Hindustan Unilever. Many of these startups were loss making at the time of their IPO. Their valuation was based on future growth, market dominance, and tech potential. That led to mixed reactions. Some IPOs boomed initially, like Zomato. Others, like Paytm, saw massive post IPO crashes. But overall, it marked a shift in the Indian market psychology. The public was now engaging with the new economy, not just banks and manufacturing firms. And this shift also brought in discussions about valuation metrics, burn rates, unit economics, and more. It made retail investors more financially literate, or at least curious. Number five, accessibility and financial inclusion. India's financial system has made huge strides in inclusion. Think about this. UPI has over 10 billion monthly transactions. The Jan Dhan Yojana gave over 50 crore people access to bank accounts. Aadhaar simplified verification, and mobile data, it's the cheapest in the entire world. This digital infrastructure isn't just helping fintech, it's fueling investing access. You no longer need to live in Mumbai or Delhi to participate in the stock market. Investors from small towns across India are opening Demat accounts in record numbers. This is creating something called a bottom up wave, which essentially means that capital markets are no longer elite playgrounds. They're mass participation tools. SEBI too has played its part by pushing for faster settlements, mandatory investor education, and cleaner disclosures. Investors like T plus one settlement, meaning trades are settled the next day, make India one of the most efficient markets globally. Number six, right risks and reality checks. Now, I know this all sounds like a win-win situation, but let's be real. Rapid growth also brings lots of risks with it. Many retail investors enter the market without enough education or risk tolerance. A bull market can make anyone feel like genius. But when correction hits, like in mid 2022 or again in early 2024, panic selling begins. Also, there's a rise in pump and dump schemes, fake tips, and telegram scams targeting new investors. So, while the access is good, financial literacy needs to catch up. And that's part of why I do this to help young investors make informed moves, not just emotional ones. Number seven, what this all means for India. So, what's the big picture here? India is entering a golden era of capital markets. We have demographics on our side, young population, rising income. Number two, digital infrastructure is getting built out. Number three, policy tailwinds like Make in India, PLI schemes, and many more. And retail investor base that isn't afraid to take calculated risks. Compare this with many Western markets where retail participation is somewhat stagnating. India is still in its early innings. The equity culture is growing. SIPs are becoming habits, and investing, it's no longer a taboo or risky, it's aspirational. Outro. Well, that's a wrap on part two of this series. We've covered the major reforms, risk of retail investors, and India's startup IPO wave, and how accessibility is reshaping the markets. In part three, I like to go deep into the post COVID market boom, the idea of there is no alternative in investing, similar to what we did with the US markets, and why India's valuations remain high, and what the future looks like, especially with artificial intelligence, green finance, and global macro shifts. Make sure you're subscribed and drop a comment if there's a specific trend you want me to explore. See you in the next one. Thanks for watching, guys. Bye bye.